Hello and welcome. Although many taxpayers have just recently filed their 2018 returns, it is already time to take steps to reduce your 2019 tax bill. In this on-demand webinar, OJM Group Partner and CPA Carole Foos discusses tax reduction opportunities in choosing between itemized and standard deductions, a possible double deduction for business owners, and the importance of a tax-efficient investment portfolio. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. We'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Hello, today we're going to speak to you about some year-end tax planning tips for 2019. Many of you may just be completing your 2018 tax returns after extending them, and yet we all know it's already time to look toward the end of 2019 and see what steps you might be able to take to reduce your 2019 tax bill. Now, for many of you, if you have just filed your returns, you might not have had a lot of time to reflect on how the Tax Cuts and Jobs Act, which was passed at the end of 2017, really affected your tax bill. 2018 was the first year that was in effect for most of the provisions of the law. So we want you to have a good understanding of how that law impacted you. If you didn't get a chance to speak to your CPA about that with your 2018 tax return filing, you'll probably want to do that as step one in your year-end preparations for 2019. One of the biggest changes that you might have seen for your 2018 tax return was the difference between itemized deductions and standard deductions. What happened under the new tax law was that state and local income and real estate taxes are now capped at a deduction of $10,000 in total. So for those of you who are joining us who may be in states with pretty high state income taxes, this was a drastic reduction in your itemized deductions. What we saw many clients do was actually take the increased standard deduction in 2018 versus taking itemized deductions. So for 2019, the standard deduction will be $24,400 for married taxpayers filing jointly, or $12,200 for single filers. As I mentioned, if you're only able to deduct $10,000 of state and local income and property taxes, you'll have some mortgage interest perhaps and some charitable contributions. If the combination of those doesn't get you your deductions above that standard deduction level, again, $24,400 for married taxpayers, then you would choose to take the standard deduction instead of itemizing. If this happens and you do like to make charitable contributions, which I know many of you do, one thing to consider would be bunching your charitable contributions. So effectively making 2 years worth of contributions in a single year and then itemizing in that year, knowing that the following year you're not going to make your charitable contributions and you'll take the standard deduction in that year. Now, another way to do this bunching of charitable contributions is to consider something such as a donor-advised fund. You can contribute 2 years' worth of donations to a donor-advised fund, for instance, in 2019. That way, you'll get the full deduction for the amount that you contribute to the fund in 2019, but you can then spread your donations out from the fund to the charities of your choice over 2019 and 2020. So the charities will still receive those donations every year, but you get the benefit of bunching the tax deduction into one tax year. Another thing to consider, if you might not be itemizing your deductions, is the impact that this has on your mortgage interest. Certainly when a lot of people are looking at mortgages and thinking about the interest rate that they're paying, they're also considering the fact that that mortgage interest is tax deductible. So, a couple of things to consider on that. One, mortgage rates are at near record lows still. The Fed recently decreased interest rates again, so those mortgage rates are expected to stay relatively low. Chances are you're still earning more on your investments out in the market than you would be by paying off a low interest rate mortgage, even if you're not getting a tax deduction for that interest payment. But again, it makes sense to take a look at that and evaluate what's the after-tax cost of your mortgage versus the benefit that you're getting. Section 199A, which is the new pass-through deduction, was a big topic of conversation for many small business owners in 2018, because that was the first year that that qualified business income deduction came into effect. For those of you who are business owners who happen to be in a specified service, trade, or business, certainly medical practices fall into that. Also, consultants, management companies, accountants and attorneys fall into that. You might be looking at ways to try to reduce your taxable income to fall below the threshold amount that allows you to take that qualified business income deduction, even if you are a specified service trade or business. Those specified service trade or business rules go away below certain threshold amounts of personal taxable income. So some of the ways to get your income below those threshold amounts are doing things like evaluating your qualified retirement plan. It might be implementing a defined benefit plan, such as a cash balance plan, or it might be just enhancing your current qualified retirement plan to get more dollars into that plan, which allows you to take a bigger deduction against your business income, and perhaps that will push your personal taxable income below those threshold amounts. And that's around $360,000 for married taxpayers for 2019. The combination of getting that qualified business income deduction along with getting an enhanced deduction for a qualified retirement plan contribution often goes a long way towards paying the cost of that qualified retirement plan contribution. So that's definitely something to think of. A special consideration for any business owners who actually own an ambulatory surgery center also came about in the final regulations that were issued for Section 199A. There was an example in those regs that talked about surgery centers where no physicians or nurses were employed by the surgery center, and the surgery center's income was simply a facility fee that was charged. What the reg said was, in that situation, the surgery center would not be a specified service trade or business, and therefore could take the qualified business income deduction. So if you are an owner of a surgery center, you should definitely talk to your advisor about that and whether you may qualify for that qualified business income deduction on your surgery center income. Investment income is a great tool to look at to evaluate tax savings opportunities that you might have. Some of the things to consider on that would be the timing of your sales of investments. There's a lot of volatility in the markets over the last few years. If you're thinking about selling some of your investments, and you're going to have a gain on those sales, then certainly look at the holding period of the investment. If you've held that investment for more than 1 year, you will get long-term capital gain treatment on the sale. The long-term capital gain tax rates are a maximum of 20% versus 37% maximum on short-term capital gains. Now that's before the Affordable Care Act surtax, but you're talking about a 17% difference in the tax you pay whether you sell an investment after 11 months and 29 days or after 12 months. So think about that. Also, it's very important to consider harvesting your capital losses against capital gains. If you've sold a lot of investments at a gain this year, you might look at some of your investments that you're carrying at a loss currently. Think about selling those and realizing the losses so that they can offset your capital gains. And conversely, if you've sold some investments and have a large capital loss, keep in mind capital losses in any one tax year can only be taken to the extent they exceed your capital gains up to $3,000. So if you've got a large loss, think about generating some gains to offset that loss so that you can fully utilize the loss. Otherwise, you'll be carrying that loss forward. We also like to tell clients it's very important to make sure you own the right investments in the right accounts. So make sure that you're holding proper investments in your retirement plan accounts, which don't generate any current taxable income. So if those investments are spinning off income each year, you're not paying tax on it until you take out the distributions. If you've got after-tax brokerage accounts, though, that are spinning off a lot of dividend income or interest income, you're going to pay tax on that income each and every year. So look at how you own your investments, make sure they're properly structured in the right accounts, and you can talk to your investment advisors about that, or our investment advisors at OJM are happy to talk to you about that as well. It's also a great time to be thinking about your estate tax planning. You may think, why do I need to do that? The current exemption for a married couple for federal estate tax is $22.8 million. However, as of right now, that exemption is due to sunset at the end of 2025. So it might make sense to think about transferring some of your wealth to a trust for the benefit of your heirs. Assets that you know you won't need in your lifetime can thus be protected against future estate tax increases and future reductions in that federal estate tax exemption amount. So that's another thing to think about just in terms of estate planning and the fact that that exemption might sunset at the end of 2025. There's the old saying, failing to plan is planning to fail. So the fourth quarter of 2019 is a great time to be getting your 2019 taxes in order and looking forward to 2020 as well to make sure they're in order for that. As many of you know, we talk a lot in our firm about tax diversification. To the extent you can reduce items that are going to be taxed at ordinary income tax rates, which again right now are 37% top rate, down to capital gains rates, which are 20%, or into a bucket that is tax-free. That's some great ways to create a tax hedge against future tax rate increases. Thank you so much for joining us today.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.